Well, good evening, everybody. Welcome to the second half of our presentations today, entitled The Jamboree, Building Better Portfolios. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing and a volunteer for the Mid-Michigan chapter. And Ken Kavula, my dear colleague from Mid-Michigan, is the president of that chapter. You guys all know him as one of the voices on Ticker Talk very regularly in a number of better investing programs. So thanks for this program, Ken. I think it's outstanding.
Well, let's take it away. We have a disclaimer as usual. This
Well,
is the Mackinac Bridge up here that I should talk about. You're going to talk about it, or am I going to talk about it,
yeah,
Mark?
go ahead and talk about it.
Well, this is the Mackinac Bridge, and it was built in the 50s. And we hope that we're building some bridges between ourselves and better investing, manifest investing and better investing, because we think that both organizations complement each other. I'm going to talk about validation a little bit in this particular class and about how I use manifest investing to help me do stock selection guides. Right now we're trying to get the middle of that bridge to join together. That's a very, very exciting picture in the upper right there,
That's a good one.
because
Well,
those are kind of balanced. A suspension bridge actually is suspended, hence the name, from those big, heavy, loopy cables that you see.
yep.
And that's when they've begun to suspend the roadway, and they haven't quite finished it yet. And they're not quite balanced quite yet, because eventually that middle part has to meet together to finish so you can go over the bridge. So
Well,
really interesting picture there.
one of my favorite pictures. Most of us, I think almost all of us, are familiar with the picture from the 1920s of the guys. They're actually steel workers, sitting on the
Eating
girders
lunch.
eating lunch.
Yeah.
Okay, so the one on the lower left is from the Mackinac construction, and I think it might even be worse, because the picture doesn't do it justice, because the lake is several hundred feet beneath them, and they're walking on these little cables with nothing but net, and I don't see any safety ropes or anything.
I think those little things are handles that you can hold on to as you're walking, Mark. I
Uh,
think that's kind of like a push thing on the cable.
so anyhow, I think, and again, I'm really stretching for allegory here. Sometimes investing feels like this. And
Yeah, you're stretching.
I really have a strong conviction that it gets easier investing with your friends and family.
And I think this also demonstrates the patience and discipline you need to, and maybe also a little bit of fear when it comes to really putting your money where your mouth is. Okay.
Fear can be a very good variable. All right,
Let's go to the disclaimer real quick.
go ahead.
We're not the boss of you. We're going to give you some ideas. We're going to talk about some things that we believe and some things that have been successful for us. But we expect you to do your own homework and make your own basic decisions, especially about buying stocks, selling stocks, or holding stocks. We would like to share the slides with you. If you'd like a copy of them, drop an email to either one of us, Mark R. or K Kabula1, either one of those email addresses, asking for the slides, and we'll make sure you get them as soon as we have a moment. If you have questions or questions you don't get answered during the session today, drop us those questions, and we guarantee we'll get you an answer. It might not be immediate, but we guarantee we'll get you them. And if you have suggestions for something for us to talk about at the bull session or for further educational sessions, include those as well. We'd love to hear what you'd like to hear, and we're up for putting some things together if we feel they have a lot of interest to a reasonable number of people within the chapter and on our guest list.
Well,
So,
speaking of up for it, check out that guy on the lower left, running around up there on that tube.
that's the tube that contains the main cable, isn't it?
It is. So
Yeah.
he's up there, and then I used to be able to do that when I was younger. I can't even get on my roof anymore.
I get squeamish driving over this bridge. It is quite a ways above the water, I'll tell you. Here's our biographies. We're not going to read those, and we're not going to give you time to read them. If you're interested in what we've done in the past and a little bit about our wives, ask for the slides and read these at your leisure. That's my wife of 50, almost 56 years now, and that's Wendy, Mark's lovely wife. So I think they're outside of Buc-ee's, aren't you, Mark?
Oh, we're inside Bucky's next to the pickup truck
Inside Buc-ee's.
and,
Okay.
and waiting for that IPO. Anybody out
We're
there?
sitting. Go on. We're sitting at an Italian restaurant in Florida, and we don't normally sit in Florida, so this was a rare moment for us, I'll
I
tell
thought
you.
that might be the Riverwalk in San Antonio, and you were just teasing me.
No, it's not. It's not.
Here you go.
So let's get started, okay? We want to beat the market. That's our goal, and that should be the primary motivator of anybody that's putting together a portfolio. If you're not going to beat the market, then why bother putting together your own portfolio in the first place? If you're not focused on doing better than an index, then there's no reason to put your time and effort into trying to create your own portfolio. I will tell you, however, if you have a little bit of knowledge and a little bit of discipline and quite a bit of patience, it's a fairly regular thing with better investing portfolios that they do beat the market by one or two or more points. In our first class, we emphasized the importance of sales growth in this portfolio because everything starts with sales. Earnings follow sales. If sales don't go anywhere, neither do earnings. And if earnings don't move in an upward direction, then neither does the stock price. Over short periods of time, those rules do not hold necessarily, but over long periods of time, they're the gospel. Earnings follow sales, stock price follows earnings. We're going to need some tools to help us manage our portfolio. And the first button, a bullet point there says that we hope you use the stock selection guide. We don't want anybody in any of our classes to not understand that the stock selection guide, that process is the basis for every single stock study that Mark does and every single stock study that I do. They will help us to continually evaluate our companies. Sometimes, however, we think that a lot of our people and a lot of our clubs don't focus on what's most important on the stock selection guide. It's not the upside downside. It's not trying to do financial shenanigans to figure out the PE values. It's the answer, and there is an answer on a stock selection guide. It's called the return. It's down in section 5, and you can either use the total return based on your high judgment PE, or you can use the average return based on your average PE judgment. Either way you look at it, that's why you do a stock selection guide. Adding a manifest investing tool to your stock selection guide, I think, does two very important things. First of all, it gives you somebody else's opinion about the stock you're studying. It helps validate your SSG. So if your par value, potential annual or average return, if your par value is 10 and manifest's par value is 9.4, those to me are the same numbers and my study's been validated. If my study is somewhere way different, then maybe I'm having something that I need to rethink. The other thing that the toolbox using manifest investing will give us are weighted averages of numbers that if we were to generate and collect these numbers, the arithmetic might be overwhelming, especially since the numbers will change every time the price changes. So with the manifest dashboard, we're going to be able to get some numbers. Here's the homepage of Manifest Investing. It's a brand new version. It came out January 1st. It has a few bugs, let's admit that, But
Yes, we're a work in progress.
changing those we are changing those bugs just as quickly as they can be discovered, and we'd like your help. If you're a subscriber, start playing around with the uh, website, and if it's not doing one of the things the way you think it should be doing it, press that little button in the upper right hand corner. It looks like a person inside of a circle. Press that button, and on the list that will show up after you press that button, it says report a bug. Well, just write down what's happening and report it. Kurt will look at it, and in my experience, sometimes those bugs have been fixed in a matter of minutes. Sometimes it takes a little bit longer if it's a serious bug, but we need you to help us discover what they look like. This page, by the way, folks, scrolls down. It keeps scrolling and scrolling, and there's all kinds of interesting stuff on it. So don't be afraid when you get to any of the Manifest pages to scroll. Let's look at more of Manifest on the next slide.
This actually shows you new features. This is a tour that Kurt actually gave of the works in progress. So you can find both of those.
I'm going to start with the research tab. There's a series of tabs across the top, and I think they're all pretty explanatory. Events, you understand that. There is a very active forum of a Manifest community where you can ask questions and get answers in real time a lot of times. Dashboards, we're going to look at it in a second. There's a great screening tool, and you can look at publications as well, which will give us a lot of ideas for doing further work on your studies. But right now I'm going to look at research. And if you go to the next tube, when I click research, I get a drop-down menu, and I'm going to look at companies on the drop-down menus right here. So let's go to the next slide, Mark, and I can do some more talking. What comes up on companies is what you see right here. This list of stocks, and that list is about, today it was about 40 or 45 companies long. This list of stocks right here is an idea list. Mark is underlining it was 50 long today. Okay. And that idea list is nothing more than some very high quality stocks that happen right today in today's study to have pars that are in the sweet spot. And the sweet spot means that we're looking at stocks that have the potential to give us a return of somewhere 5 to 10 points above the average return for a stock in this database. So the average return, it's referred to as MIPAR, Manifest Investing Potential Average Return. The MIPAR number is the average return for a stock in the database. The sweet spot is 5 to 10 points above that. And the sweet spot is based on George Nicholson's teachings. Our goal from the beginnings of Better Investing have been to beat the market by 5 points. Nicholson didn't have a computer. He didn't even have a calculator or an adding machine. He had a slide rule and logarithms. And to explain beating the market when the market was variable was something that just couldn't be done in the mid-40s back in the last century. But Nicholson knew the stock market moved at about 10% a year over long periods of time. That was a good, solid average for the stock market then, and it is for the stock market today. He also knew, or thought he knew, that a good club could beat that average return by about 5. So we get the number 15 when you take the long-term stock market average of 10 and add 5 to it, 15. That 15 is one of the most misunderstood numbers in all of Better Investing orthodoxy, and we've talked a lot about that in the last class. We'll talk a little bit more about it in this class as well. We know the market is variable. That MIPAR number, I've seen it up into the mid-teens or even high teens over my investing career, and this is not even the lowest that I've seen. I've seen that MIPAR number down into the 5s at various times over my investing career. So it varies, and our job is to try to stay 5 points or better on top of that number if we can. Um, that's what you get. And you also get a place, if you, Mark has it covered right now with a big red arrow, but there's a little box right underneath that circle on the upper right, and it says a place where you can put in a ticker. So let's go to the next slide and we can show what that looks like, Mark. I put him to sleep.
No, I'm here. I just didn't advance. Did I do something wrong?
There we go. Just didn't advance. Okay.
I'm not.
So I
I'm not
circled
very
where you
advanced.
fill it in, and then I filled in a ticker. Folks, I did this ticker, I did this slide 5 or 6 days ago, and I did not anticipate Microsoft moving quite the way it moved today in the market. It was down about 10% in the market today. But Microsoft is just an example. You fill in a ticker there, and then one more slide, Mark, and this is what you get. And we're not used to, in Manifest at least, seeing a picture come up when we type in a ticker. This is not exactly a new feature, but it's been a feature that a lot of you never scrolled down far enough to take a look at. We think it's kind of important, so now it's taking center stage when you first open the company. That line above the graph is something that you should be familiar with. You've seen the growth number, that's sales growth. You've seen the prove number, you've seen the quality number, and you've seen the par number in the old website. Those aren't new, but the price is now updating with the market. So you'll have a date and a time when the market is actually in session, and this will continually during the day be updating itself. And when the market's closed, you'll have the closing price from the last trading day directly underneath right that. There's a place where you can hover that little symbol up there, and the day I captured this, Microsoft had gone up that day in its stock price. And if you hover over that, you'll get some information about the previous day's close and what was going on. The graph is really intuitive. It's a little bit complicated, and you can break it into pieces by using those buttons directly above the horizontal blue line, those buttons right there. But here we're looking at the entire chronicle. That's what this is called. And that blue line at the very top is showing you quality over 5 years. You'd like to see quality that's moving from the lower right to the upper left, or best case scenario, you'd like to see quality that's horizontal at a high value. And that's what Microsoft has. That red line, that's the par value, the potential average return over a 5-year period. Okay. And you notice that Microsoft is not especially volatile when it comes to their par value. Some companies, when you'll look, you'll see pars that are negative, and then you'll see pars a year or two later that are extremely positive. Microsoft's kind of relatively stable. That blue banding, that's the sweet spot over time, the top of the sweet spot and the bottom of the sweet spot. And if you were to hold your cursor anywhere on that band, you'd get some numbers. The number would be telling you the date you've chosen, and then it would be telling you the top of the sweet spot, and assuming you're smart enough to subtract 5 points from that to find the bottom of the sweet spot. Those green bars, those are adjusted. That means they include dividends. They're adjusted price bars quarterly for the last 5 years.
Those are actually monthly.
So, monthly, I'm sorry, for the last 5 years. And when that red line, that when that red line, the par value, moves up into the blue banding, that's the sweet spot, that's telling us that you might be looking at a really decent buy for this or any other stock. Mark, I'm going to take a breather and let you give me anything more about this and then take the next slide.
Well, today it closed down 11%. The par is now up here. So the par right now, the projected annual return for Microsoft is at a 5-year high. So if you don't already have too much, Microsoft happens to be our largest personal holding in our family portfolio. So
Likewise.
we may not be adding any more. We're certainly not panicking, mostly because of that flat blue line up at the top. But for some reason, Wall Street has decided to beat up on Microsoft, and you can experience this real time at Manifest now. So it'll be interesting to watch this stuff. We do have to fix a few of these chronicles. If you find one that's clearly not split adjusted, send me a note and we'll get it fixed. We do have a bit of a backlog there, but we will figure that out. So again, I think it just gives you everything you need to see quickly. I mean, I heard Microsoft at the end of the day today, and I quickly snapped over to Oracle to take a quick look, and more on that later probably.
Mark, we have a good question from Tom. Tom goes, if my par is the average par for the stocks in the database, where would you find par for your own dashboard? We're going to show you that, Tom. If you just stick with us for a couple of minutes now, we're going to show you all that where you can find it for your portfolio, okay?
Let me spend just one quick minute on the notion of what are we really looking at? What you're really looking at is a consensus stock selection guide. As if you had put every analyst who covers Microsoft, in the case of Microsoft, that's probably 40 or 50 relatively gifted people. And you basically are forming a sales growth forecast and all the milestones, the profitability, and a return forecast based on their analyst research. So it really is an aggregation, and we at Manifest make very few decisions about any of the components of any analysis as we go through it. One example might be we make a decision on, let's say the company's gone through a series of mergers and acquisitions. So we might define what the relevance period or what is the true continuing operations company. We will make that decision, but that's just one of very few that we make. What you are looking at is a consensus. They're not always right. We all know that. But it is an important input to consider. Like Ken said earlier, if you're pumping out 10 and they're looking for 2%, it's time to figure out what's causing that difference, and then what do you believe?
In fact, that's what this slide says right here. All right. I first used Manifest when it first came out. I have dashboard number 3 in Manifest, and it first came out.
You're getting a bell.
I'm getting a phone call from somebody.
An
Yes.
award bell.
And I used it to validate my stock selection guide. I thought that it was important that I be able to validate not just the companies where I could find a complete written analysis. Microsoft, I can get a lot of analyst opinions in a lot of different sources, but I was very interested in smaller stocks and trying to find opinions about growth for some of the smaller stocks was very, very difficult. Manifest gave me an opinion on almost any stock I could come up with. And I like to take and see what my par was and then what Manifest said the par was. And again, if they were significantly different, I did not immediately jump to the conclusion that I was wrong, but I did jump to the conclusion that I wanted to do a little bit more research and find out why there was such a difference between the two numbers. Occasionally, I think that Manifest is absolutely wrong, and that's not blaming Mark or Manifest, that's blaming the analyst community, and it's because I think that they've made a fundamental mistake somewhere. Doesn't happen very often, but when it does, sometimes that becomes very, very a great thing to do because you're running against the herd and you have a chance to make a really big mistake or make a really big profit, one of the two. Next slide. I wish I had time to just sit here for the next 5 hours and tour Manifest and let you come and go and ask a lot of questions and everything else, but we just don't have that time tonight. So we're going to be putting together a lot of educational material for investing and for portfolio management and everything else. And we hope as we announce these classes that you'll stick with us and listen to some of our ideas, and we'll like to show you some of the things that can help you with what we're talking about. For now, let's just move to a new slide.
Did you sneak in here and take a picture of my Peloton?
Is that what that is?
Go ahead.
I just stole that off the internet somewhere, okay? When I press the dashboard tab at the top of any of the screens, here's the pull down. And I'm going to explore my dashboards, and I'm going to look for a particular dashboard in the Mid-Michigan Model Club. Now, my whole model club subscribes to Manifest. This is 19 people, and they all subscribe. And because we're all subscribers, we open a dedicated section of the website, and only the partners in the Mid-Michigan Model Investment Club can see these particular dashboards. We can designate favorites within our club, and we've designated a dashboard called MMMC, and then it's dated at our last meeting, and you can see it carries a gold star. That will appear on the main pull down menu, and that's the one we're going to look at as an example for the next couple of slides. But if I press the title of the club, I will get to all the dashboards that the club is keeping and has put together. We do a lot of industry studies, and we'll start with a dashboard on the entire industry or on the candidates for our study. It might be 8 or 10 or 12 companies from the industry that we're particularly interested in. So we have many, many dashboards that we actually use in real time for this model club. Let's look at the next slide, Mark. Excuse me. Here's what comes up when I press that starred dashboard. The name's in the upper left-hand corner up there. And across the top in that red box, I put the red box on it. It's not there in reality. But the red box is the company's, the column headings. And if you go across just visually, I think you'll say to yourself, I understand what most of these headings mean. I want to just emphasize that the growth column, about in the middle, the growth column is sales growth. So make sure when you're reading that, you're not reading any other kind of growth except sales, okay? The prove and the core score might be something new to you. In one sentence, prove has become a way for us to validate our par value. The calculation for potential return on value does not use a PE. And because it doesn't use a PE, it gives us an alternate method for coming up with return. When the prove number is relatively close to the par number, we're getting a signal that says both studies are probably are pretty good, and they're confirming each other. That's what I use it for, and that's what a lot of people use it for. The core score is basically used to separate core stocks from non-core stocks. We know that if you add together, and let's look at Google, the first line on this thing, if you add together, Mark, can you mark the three numbers that you add? It's the financial strength, and the earnings stability, and the quality number. And when you add those three together, you're going to get 270 rounded off, okay? When you get a number that's bigger than 2.25, it's probably a core company, you know, up, straight, and parallel. When you get a number less than 225, it's probably a non-core company. Caution, there's a lot of gray in the 225 number, and really there's a zone, probably plus or minus 25 or 30 points on either side of 225, where a core can be a little bit less than 225 and a non-core can exceed 225 by a little bit. So you have definite non-core below 200 and definite core probably above 250 or 260. And anything in that gray area, you probably want to think about a little bit before you absolutely identify it. Okay. Right now, I want you to focus on the bottom line on the slide. And the bottom line tells you a lot of really juicy information. There's that weighted sales average for the growth. In fact, I think if we go one more slide, we'll be able to talk about it with a little better graphic, Mark. There's that weighted sales average for growth, 12.3. Remember, I indicated in the first class and again in this class that we feel that to achieve the goal of beating the market by 5 points, you're going to need to have a sales growth average somewhere in the 12 to 13.5% range. Folks, I have deliberately given you slightly different values because there's no hard and fast rule. If you go back and read or listen to these classes again, sometimes you'll hear me say 12.5 to 13.5, 12 to 13, 12 to 13.5. Those are all correct statements because we think that's the area that you have to move growth to. I wouldn't even be adverse to see a growth as high as 13.5%. In one of the portfolios that's trying to beat the market by 5 points. At this meeting, which was about a week and a half ago, our club noticed that our growth was not quite at our goal. We set our goal at 12.5, and that means we need to focus on that for the meeting that we were attending. Let's go to the next slide. We then looked at EPS stability and financial strength. Mark's going to mark them down there at the bottom in the averages. Our goal that we have written down and we watch and talk about at every meeting, our goal for these two numbers is 75th percentile or above. Okay, and these numbers satisfy our goal at this meeting, but we would probably tell each other that we really should watch financial strength a little bit more carefully because we've noticed in the last 6 or 8 months our financial strength declining just a touch. We used to be able to keep it up around 80 and it's been declining to 75. That means that we're probably adding a little bit more risk to our portfolio by adding some lower financial strength companies. We need just to keep that in mind, that's all. Next slide. The proof score, we like to see the proof score kind of come close to the par score. So at this meeting, we compared the 8.5 in proof to the 8.4 in par, and we gave ourselves a check. They're tracking each other very closely, and that's a good thing as far as we're concerned. We also like to see our core score stay somewhere above 2.25. In other words, we want the majority, in fact, more than the majority of our portfolio to be in core stocks. We'd like about 80% of our portfolio to be in core versus no more than 20% in non-core. And this particular club is not extremely aggressive. And if I were to ask the members, I would think that a lot of them would say they'd like to see non-core stocks stay under 10% even. Those are personal choices. You can put together a portfolio that beats the market and still have a core score at 280 or 290. In other words, up straight and parallel can fill your whole portfolio, but it's a lot more fun if you have a little bit of non-up straight and parallel to mess around with. Next slide. Quality, we hardly ever even look at a stock where the quality is below 70. So I would expect our quality to meet our goal of 80 with no problem. And this is the one number when I look at better investing portfolios all over the country that I hardly ever have problems with. And I hardly ever have to remind them that they need to find high quality growth stocks. Okay. Better investing members know how to identify high quality stocks, and then they know how to be patient and wait to buy them at the right price. So this 91, 90.8 is a great quality score for the portfolio. This is kind of something you're going to have to think about after I say it, but it is possible to have a portfolio that has too much quality to it. The highest quality companies in the upper 90s many times tend to be slower growers. And if that quality moves up into the portfolio quality now, not the individual stocks, but if that portfolio quality moves up into the 98, 99 area, you might have too much quality. And I would, most of the time, if I see that, I see a growth number that is way too low for you to be able to beat the market with. So we're happy with 90, 91. We'd be happy with 85 even. Our goal is to keep it above 80. Next slide. Finally is par. And this is forecasting the potential annualized average return for the next 5 years, 8.4%. Well, you say to yourself, that's under 10, that's no good. But in today's market, with my par at 7.5, it's up there in the upper right-hand corner staring me in the face, okay? With the market average at 7.5, this 8.4 is beating the market, not by very much at this meeting, and it's certainly not beating it by our goal, which is to beat it by 5 or more points, but we're not going to beat ourselves up too much for beating the market by a point. And that's what we're doing at the moment when we compare our par, that's a weighted average, against my par. These averages, if you continue to follow them religiously and make them a part of your discussion before you decide what you're going to buy and sell, these averages will kind of direct your discussion so that you talk about important things rather than arguing about things that aren't as important in a portfolio. There are no really advanced topics when it comes to a dashboard. The numbers are out there, they're pretty straightforward, they're easy to understand, and we're trying to keep our goals simple so that everybody in the club understands the goals. Next slide, Mark. Here's the way the meeting might go. Well, you know, our numbers are pretty good tonight. Let's give ourselves a B or a B plus, okay? Let's make a short-term tonight goal of not messing up any of our numbers. Let's focus on sales growth and par because we'd like to see them both a little bit higher. And let's end the evening after we've made our investment decision with those numbers at least staying where they are. Let's set a short-term goal or so. And a short-term goal might be 5, 6, 7, 8 months, something like that. Let's make sure that we're identifying companies with lower par values that we could eventually be selling to replace them with higher par holdings, some that are in our portfolio and some that we might be watching, waiting for a place to open up in the portfolio. Let's identify our smaller holdings and either add to them or take them out of the portfolio. They're taking up our time. And if it only represents 1.1% of the entire portfolio, let's either remove it or make it a bigger part so that our partner that's following that stock is not wasting his or her time. Let's also check on holdings that have become too large and consider whether or not we should trim them, especially if the par on those too large holdings is low. Let's also set some long-term goals, 1 year or more. Let's not ever lose focus on our sales growth number and our total par number. Let's also spend a little bit time reminding ourselves that financial strength has to stay at least at 75 or better, or we're probably going to start becoming a little bit too frisky and risking our money a little bit more than we want to. Finally, we call our list of candidates the pounce list, and let's keep that pounce list supplied with good candidates. But let's make sure that list stays manageable. In our definition, manageable means let's not put more than 4 or 5 stocks on the pounce list. When that list gets to 15, it's useless, because then you spend your time arguing about the pounce list and not focusing on your portfolio. When you have 3 or 4 or 5 candidates, the one you want to pick will rise to the top with just a little discussion. When you have 15 or 20, it'll take you an hour and a half just to get one to rise to the top. And then by that time, everybody's too tired to make good decisions. Next slide.
Been there and done that.
These guidelines, I don't expect you to read every one of them right now, but if you want to get these slides, again, send us an email. We'll give you the slides. These answer some of the most common questions that Mark and I get when we visit clubs. They want to know, how many stocks is good? Our answer, 16 plus or minus 4. But we also say that the number of members in your club can help set the number of stocks you hold. If you only have a 6-member club, 16 or 18 stocks is probably too many. Maybe you should be somewhere down around 10 or 12 stocks in a 6-member club. If you're lucky enough to be in a 25 or 30-member club, maybe you can handle upwards of 20, even 22 or 24 stocks. But put those two ideas together, there are no rules. These are guidelines. Figure out always what an average holding is. If you have 15 stocks, then an average holding is about 6.5 or 7%. And use that average holding number to gauge whether something's too big or something's too small. If the average is 7, then anything under, say, 3% is probably too small. And if the average is 7, then anything over 14 is becoming too big. And if it would get to 3 times average or 21%, it's definitely too big. And then you need to ask yourself some hard questions. What do we do if the tail is beginning to wag the dog? Okay? Quicker growing stocks, and I'm not using the word small, medium, or large. Quicker growing stocks should make up at least a quarter of the portfolio, and slower growing stocks should make up at most a quarter of the portfolio. I've seen great portfolios with no stocks that are growing less than 7%. Again, I've seen great portfolios where nothing is growing less than 7%. Remember, you want sales growth up around 12, 12.5, 13, somewhere in that range. Folks, those of you that are in a club that feel you need a stock from every sector, I give you permission not to have a stock from every sector. You just don't need it.
It's a bad
Okay?
idea.
5, 6, 7 even sectors is plenty. I think most of my clubs operate with representation from only 5 or 6 sectors.
Mhm.
And folks, Better Investing never suggested that you take the dividend that you get from Microsoft and reinvest it in Microsoft. Let me ask you this question. If you're going to spend a lot of time doing a stock selection guide and not buying Microsoft or any other stock until it's in the buy zone, why would you turn around and reinvest the dividend just on a schedule of once a quarter? You take your dividends when they come in and add them to your cash pile, and then you buy what is appropriate to buy, not worrying about where the money came from. And again, we said it in the first class 26 times. Not every stock in your portfolio must return 15%. It's your portfolio's return of 15% that we're looking to achieve. And even that number is not something that is static. The growth of your portfolio, the return from your portfolio is fluid, and we're just trying to stay 5 points ahead of the market wherever the market heads. Sometimes that'll be harder to do than other times. When the market's doing 26, staying 5 above it is one of the most difficult tasks you can assign yourself. So don't beat yourself up when you can't achieve +5 to the market. Next slide.
Yeah, one of the things I thought I would mention, Ken, is it's got to do with this oversized position that we often see with Apple and Google and Nvidia or whatever. And this is just a guideline. But what I'd like to share is that, you also have to factor in what is the cash flow coming in, the deposits made every month. What effect does that have on that number? And then I would also share our real life experience with the Buttonwood portfolio during bull sessions. During December, we actually reduced a couple of the top positions, and it actually became a tax benefit. And then come January, we were able to actually replace part of that and ended up with more, reduced our average cost basis. Anyhow, it can be a very strategic advantage, and the tax benefit was cool. So you can run into situations. I would say don't hurry, but watch for opportunities to do that type of trimming over time. You don't have to rush into it, but it's something which should receive due attention in time.
Mark's absolutely right. If I'm visiting a club, the next slide has 2 words on it: patience and discipline. Okay, you don't want to do things quickly when your portfolio is out of whack. Take 6 months, take 9 months to rebalance. If it's really out of balance, take a year or more to get it where you want to. We've had all kinds of 2-hour and 3-hour and 7-hour long when to sell classes in Better Investing. But Better Investing basically set a single rule for when you sell. There it is in so many words. You sell a stock to make the portfolio better. You need to come up with a better portfolio when you sell the stock, whatever it happens to be, and you need to have some good rationale and some good evidence that you actually have achieved making the portfolio better. Remember our principles: buy high quality growth companies and buy them at reasonable prices. Mr. Nicholson has a direct quote: when do you hold a stock? You hold them for as long as it makes sense to do so. And there'll be a lot of good reasons why you want to hold good stocks, and sometimes when you want to hold even a not so good stock. There'll also be great reasons why you want to sell a good stock, and sometimes why you don't want to sell a good stock. Some of these ideas and reasons are going to fight with each other. This is not all marching in the same direction. And when some of the guidelines seem to fight with each other, It's up to you to make the value judgment as to which one's more important. That comes with wisdom and experience. Next slide. So you're at the Mid-Michigan Model Club meeting. It's the 19th of January. We have about $4,900 to spend that came in during the month. Here's our portfolio's dashboard. What might you remark in the discussion leading up to the decision? I'm going to start the discussion off.
I thought maybe
Folks,
you were
we have,
quizzing me.
well, I'm going to quiz you in just a moment,
Oh, okay.
okay?
Okay.
Folks, we have two stocks on our pounce list, Costco and UFP Technologies, and neither one of them appears to be a screaming value for us right now. We would, of course, be looking at our SSGs, and we would want to make sure that the dashboard's par is relatively close to our SSG's par value. And we have discovered, after using dashboards for a half dozen years, we have discovered that that happens 90 or 95% of the time, for us at least, okay? What I'm doing in my first discussion piece is remarking that we probably don't want to put any money into our 2 pounce list stocks. So we can either bank the money and spend it next month, or we can find something to do. Our club is very great at finding things to do, and we learned a long time ago that we have to demand reasons for what they want to do. We used to, when we were a very young club, we used to find people just making recommendations with no thought of any kind as to what it might do to the portfolio. And today, when somebody makes a recommendation, they have good reasons behind it, or they don't dare make a recommendation. Here's a recommendation that this club is in the middle of. Go down to the bottom of the list, because we have this sorted by par, and notice this wonderful company called O'Reilly Automotive. O'Reilly has sat with the lowest or second lowest par for about the last year in this portfolio. What that means is that O'Reilly has done extremely well for us. It's made us a lot of money. We have a lot of capital gain attached to it, but it's really not contributing to our portfolio. Our percent of total for O'Reilly about 4 months ago was about 9%. It had grown to be a little bit too large with a minuscule par value. And we made a guideline decision to gradually reduce the O'Reilly holding and maybe completely get rid of it at some point in the future. We've sold it 3 times in the last 5 months. And then we stopped selling for the November and December meeting because we didn't want to take any more capital gain than we already had. We put in our minutes that we should reconsider whether we're going to continue selling O'Reilly at the January meeting. So that'll be a discussion. Would we like to have $52,000 plus the $4,800 to spend tonight? Well, that might make it a very interesting meeting. And we might decide to sell the remaining 525 shares of O'Reilly. We originally had 2,000 shares of O'Reilly Automotive, folks, okay? Split adjusted, by the way. What else might you discuss? Mark, you're a member of this club. What else? He's not really. What else would you like to discuss tonight? What else do you notice?
They wouldn't have me. I'm looking at Iradimed. That's had a pretty good run also. And it's got good growth, but the par is down at 2.5. So I'm just kind of scratching my head. I would be scanning for lowest growth numbers. You've already identified O'Reilly, and Monster is just a little bit above that. Those are both still okay. This number is actually okay from where I sit. I'd like to see it a little bit higher. Obviously, we want this to be a little bit higher. So I would be thinking at the bottom of the list of, I would do a detailed dive on Iradimed to see what the real outlook is. Are the analysts being overly pessimistic? I don't know. That would be something
Well,
for the group to study.
well, Mark, you're a new member of the club, so let me tell you the story of Iradimed, okay? Iradimed took off for us, and we sold a piece of it, but we were very aware of the advice that Mr. Nicholson gave us a number of times by telling us to be very careful about getting rid of all of a company that is growing at double digits. And this one's really growing at double digits. In addition, Mark, this is a rare example where our SSG is a little bit more aggressive than the SSG that Manifest is doing. And
Okay.
our SSG is showing us a par value that's up in the 5 or 6% neighborhood. Now, that's not gangbusters, but it is a lot closer to an average than the Manifest number shows. Iradimed has been very, very good to us, especially in the last couple of months. And maybe that low par number on Manifest is just the fact that the analysts have not yet caught up with the extreme growth the company is exhibiting.
Yeah, and you've got a little bit of support right here with the prove at 3.9. There's room for upside.
Yep. Yep.
So yeah, I would, like I say, I would rake it over the coals, but probably not do much with it.
Yeah,
Um,
Mark and I could continue this discussion now, folks, for a long time. And our meeting, sometimes we will spend as much as 25 or 30 or 35 minutes on this type discussion. Sometimes the decision is very easy for us to make, and sometimes we end the meeting with our $4,800, which in this portfolio is now worth $2 million. This is
mhm.
the Mid-Michigan portfolio. And in a $2 million portfolio, $4,800 is not going to move any of these numbers very significantly. We're going to have to do some other things to move our important numbers. And one of those would be selling the last position in O'Reilly, giving us 55,000 approximately to play with, and that might start to help us a little bit with our sales growth and our par if we're very, very aware of where we're putting the money up at the top.
I have two other things I would point out to the group if I were a member of this club. I think this ASML is headed for a slight upgrade on fundamentals based on the stuff that's going on with Taiwan and NVIDIA. And they basically cover a whole bunch of the semiconductor market. So I would be watching for the next analyst update on ASML. The other place, and this is what I would really have fun with this club, is I would love to debate this one up at the top. It's only
Well,
0.2% of the portfolio. It's got a 20% par. It is a personal favorite. But and the question I would have for the club is the growth unraveling? Are they losing customers? Are they cutting prices to keep customers? What's going on with this company? And what does your club think?
well, I'll tell you that our stock watcher for NICE has pointed out that even the growth numbers in Manifest itself have been trending downward.
Okay.
I'm
Analyst.
not certain that that NICE holding is going to stay around for very long. And frankly, it's been at that little tiny piece because we got really excited about it about 8 or 9 months ago.
Uh-huh.
And then you keep reading and you keep reading and you keep reading, and we're getting less and less excited about it. So it's not a big enough piece to have anything to do with the portfolio one way or the other. Removing the par and the growth from the portfolio will not change the averages, and
Exactly.
we'd have to begin to add a lot more to it, and that means we'd have to have some conviction on that particular stock. Again, folks, we can carry on a lot of really good conversations about this portfolio. We'll be doing some of exactly this kind of thing when we look at your portfolios at the Jamboree on Saturday. We're starting at 10 o'clock Eastern time. But I want to finish up the very few slides we have here because I want to point out a couple more things before we leave, okay? There's a function on the Manifest site. When you get to a dashboard, I've circled it up at the top there. It's called a worksheet. And what we use these worksheets for is to facilitate our discussion. When you press worksheet, this window opens, and if you're coming up with a brand new worksheet, I want you to press draft, okay? That's why it's there. And up comes a copy of the dashboard itself. An exact copy of the dashboard is there. But now, off to the left of the name of each stock, you'll notice there's 3 little dots. You'll also notice that the cash will stay at the bottom even when we scroll the different holdings up and down in the white window that's in the worksheet itself. Those 3 little dots are going to allow us to alter the shares, to completely remove the stock from the portfolio, or to suspend it for the moment for the portfolio. Okay, when you press those dots, some English words appear and some icons appear, and they're very clear to everybody. If I was going to suspend NICE for the discussion, we would press the suspend button, and then the value of NICE, you see the 45.77.60 value, that value would automatically add itself to the cash at the bottom. I could then go, and I don't think I would do this, but I could then go, let's say, to Technoglass, and I could say, let's buy 40 shares of Technoglass. And then the cash would readjust itself to reflect the purchase of 40 shares at $50.64 a share. 40 times 50, $22,000. Okay, and so the cash would then go down $2,000, and of course the share count and the value would go up. That would change the percentage. You get the idea. All the numbers that need to change are changing automatically, and especially the averages at the very bottom are changing as you play. Once you've tried a scenario out, you can decide if that's what you want to do, and if it's not, then you go over and press reset. And you play again, because reset takes you back to where it is right now before you've done anything. If you like what you've done, you can press apply, and that will now make this dashboard replace the dashboard that's in your memory. If you want to keep this, but also keep the old dashboard, then you save this as a new dashboard in your memory. These are so flexible, and they will take 1 or 2 or 3 months with your computer operator to make them work smoothly so that everybody understands what's going on, but they will also help you make great decisions without huge arithmetic mistakes. I can remember playing with portfolios 8 or 9 years ago before we discovered the utility of a dashboard, and one arithmetic mistake can upset the whole apple cart when you're making a complicated decision about your portfolio. Give these a try once you get used to dashboards themselves. I don't have time to demo the worksheet, but I guarantee it'll facilitate some lively discussion. That model club that I've been talking about, remember I showed you in the previous class about how it's performing, and the performance in great, I'm not overreacting, I'm not overselling it. That increased performance in the last 3 years has a lot to do with the use of the dashboard and the use of the worksheet. So give these things a try. Now we're going to look at actual portfolios, have some great discussions about them. If one of them is your portfolio, we're going to want to involve you in the discussion. That's going to be Saturday at 10 o'clock Eastern Standard Time, January 31st. If you haven't registered, go to the Mid-Michigan page on the Better Investing website and you'll find links. If you're a Manifest Investing subscriber, hit events and you'll find links there as well. We hope we've opened your eyes to a few things. We hope we've piqued your curiosity, and we hope that you're able to begin some of these processes. We plan on talking more about these topics at bull sessions, at roundtables, and if the interest is there, we're going to keep talking about portfolio management in future educational presentations as well. And those will go to the entire country that's on our guest list. Thanks a lot, folks, for your attention. I don't think we have any more slides, do we, Mark?
Well, I had to sneak a couple animals onto the slide, and then I also have to
I
remind myself.
noticed that. I didn't say anything,
Don't,
okay?
I just have to remember not to book something on the day that I'm tabulating groundhog results. That's a live action photo from our conference room last year. We have a crackerjack team of accountants come in and do the groundhog tallying, and the pizza boxes and spilled beer cans, they're everywhere. It's ugly. It's ugly.
I'm looking for questions now on the website here. Brian says, Mark, my worksheet doesn't have 3 dots, but 4 small icons. Well, Brian, all that means is that between my screen capture and tonight, Kurt has decided to actually put the icons there rather than the dots. That's all it means. They'll do the same thing that the dots did. The dots just opened up the icons. So you should be all set, okay? Tim says, do you utilize Morningstar ranks to help determine if the stock prospect is over or undervalued at this time? Mark, take that question, would you?
We use Morningstar as one input. I wouldn't use them as the only input to make that type of a decision. But so the answer is no, it's just a part of the answer.
Timothy is not talking about the portfolio, but Timothy has a question. He says, I'm sorry, this is Tony, not Timothy. And Tony says, I see the club owns NICE. Is this a foreign company? Answer is yes, it's an Israeli company. If so, does it give you any problems at tax filing time? Tony, the answer is no. The accounting system, whether you're using iClub or Bivio, the accounting system will take whatever your broker sends you, and if the broker has had to pay some foreign tax from your dividend or had to pay foreign tax period because the company has done something, or if there's some other kind of a deduction that occurs because it's a foreign company, your accounting system and your treasurer will be able to key all that information in, and it will all appear divided out correctly on your K1s that you get at the end of February or very beginning of March. So the answer is yes, there are a lot of times different dollar amounts associated with owning a foreign company, but your accounting system will handle all of those. I know a foreign company that I own, for example, charges me a fee for, it's called an ADR fee, and it was $4 for this company. It wasn't NICE, but a different company. And so my accounting system handled that as an expense with no problem at all. Don't worry about buying these foreign companies. What I would worry about is whether the foreign company actually exists. We have had, Mark and I, experience with Chinese companies that actually don't exist. They're complete, utter scams. And if you want to talk about hogs, we can talk about that offline.
No, we don't want to
Any
talk.
other?
We
I'm
don't want to
looking
talk.
at see if we have any other questions here. Bethany, if the portfolio, if your dashboard is going to show a company where the data doesn't seem to exist, your first line of action is to drop Mark an email and say, is it possible to cover, and then give him the name of the company and the ticker. Sometimes we can cover a company that's not presently covered. When you're looking at small companies or newly created companies, sometimes Mark will answer, yes, I can cover it because I have enough information. And sometimes he will have to tell you that he can't cover it. And then you're going to have to decide, is the company important enough to add to your portfolio because it's not going to be picked up in any of the arithmetic.
Sort of like
That
when a company has no
very
sales or earnings, right, Ken?
often. Yeah, if a company has no sales or no earnings, it's awfully hard to do an SSG on it. And Mark will tell you then that he can't cover it at the moment. And he might tell you to ask again in a year or 2 years, but you'll just have to accept that. And if you're still looking for a non-core with no sales or no earnings, then you're a very brave person. I hope you're spending a small amount of money on that company. That's all I have to say.
She is
Okay.
brave. I just pulled up Tin Cup. I'm showing 3 dots. Brian, if you're seeing 4, maybe one less adult beverage.
No, Brian is seeing 4 icons.
4 icons. Which icons?
Well, it would be the on the worksheet, Mark, and they would be icons about deleting or changing shares or something like that. Brian, I think you're going to have to communicate with Mark offline
Okay.
and maybe make a screen capture and show him what you're seeing. Okay,
We love screen capture.
Evelyn, I just cannot pick up requests from this chat log. Could you please send me an email requesting the slides, please? Okay. My email address, we'll put that on the screen in a little bit, but I just can't pick up requests from the chat box here. That makes it much, much too difficult for this volunteer. All right. Let's see if I have another question.
KCabula1 at Comcast.net or Mark R at ManifestInvesting.com. I get up earlier than Ken does.
Yeah, Tom is saying, isn't the reinvesting of dividends a dollar cost averaging idea? Tom, I've heard that argument before, but listen to my argument. Why buy a stock if it's not in the buy zone? And that's what you're doing when you're letting something just reinvest itself, reinvesting the dividends. There are times when stocks are really very overvalued, and I don't want to buy more of them at that high price. Okay. And this dollar cost averaging concept really doesn't have to do with very, very small amounts. And the dividend in relation to the total holding is usually an extremely small percentage. I don't think you're dollar cost averaging when you're adding another 10th or 20th or even a full percent to your holding. I would rather allow that money just to be in your pile and then buy what's best
Yeah.
at the time when you're spending your
That
cash.
might, that might be a
That's my
good,
opinion, though.
that
These
might
aren't
be a,
rules.
yeah, that might be a good bull session segment because it can get quite unruly. We don't dollar cost average. We invest regularly and we strategically select. And, and,
Absolutely.
and those are 2 different things.
Every purchase that we try to make in our portfolio and the clubs I belong to, I try to make it a purchase that I would make whether I already own this stock or I don't own this stock. I wouldn't look at a stock with a low par that I already own and say, let's add another 50 shares to it just because I think it should be a bigger holding. It just doesn't happen. We're focused on sales growth and we're focused on the total par when it all comes. And when you buy stocks at too high a price, you're probably buying them at too low a par.
That would be a good segment because people argue, rule number 2 is reinvest dividends. And I like to point out that that was written approximately 40 years before dividend reinvestment programs existed.
Yeah. Phil
Hmm.
uh, is asking for a retirement portfolio. Might you slow down the sales growth? Absolutely,
Absolutely.
Phil. Absolutely. If you're more comfortable as you get older being more conservative, there's nothing wrong with that. I don't set my hair on fire nearly as often as I used to, and I don't think any of us retirees should be doing things like that. So, if you want to increase the percentage of slower growing stocks as the portfolio joins you in retirement, that's your choice. We're not setting rules. We're setting guidelines, and I want to make the point that guidelines for clubs are many times different than guidelines for individual portfolios, because ideally a club portfolio can live for 100 years or more. Because if you're allowing your club to age gracefully and add new people that are younger, then that club can go way past where our own life expectancy happens to be.
Yeah, well,
This is a lot of philosophy now that we're getting
oh,
into,
yeah,
but
yeah,
it's
but
interesting.
it's very practical philosophy though too, because as my mom approached her 80th birthday, we sat and we dialed down the growth target to 8%. We dialed up the projected dividend yield up to 4 or 5%, and we dialed the quality up to like 95. And that's how we reconfigured the portfolio for a person that met her conditions.
And I will just counter that with my mom, who lived to be 89 years old, and she was in the family club for about, oh, I don't know, a dozen years or so. And at age 86, I have a quote from her that says she's investing for the future. None of this sitting on your rear end and not worrying about the future. So she was still investing the same way she had invested. Phil is asking about Prove and Par, and he's showing that the Prove and Par for a couple companies are fairly close together.
Mm-hmm.
And he's asking me, are they keepers? Phil, Prove and Par, Prove especially, I don't use to determine whether it's a keeper or not. Prove I use as a validator, and Par is not necessarily a keeper. It depends on the portfolio. Just because it has a 45% par does not necessarily mean it's a stock that I want to include in my portfolio. There's other things that must be considered. Financial strength must be considered. Quality must be considered, and many, many other things. Par is not the overriding reason why you put a stock in the portfolio. It's probably just one of the more important reasons
One
why
of
you include it.
Lots of good questions. Yeah,
Yep.
for
Let's
those of
see
you
if
that
I.
are curious about Prove, let me give you a 30 or 45-second summary. Prove is basically a return forecast based on the work of Joel Greenblatt. You'll have to Google Joel Greenblatt to understand why we would pay attention to Joel. What it basically represents is more consideration of cash flow and the capital structure of the company. So it actually includes the debt, the liabilities, and the cash in the wallet. So it's basically looking at the capital structure, very mindful to those parameters. And yes, the prove should resemble the par. If it doesn't, then there's something else weird going on usually.
Herman wants to know what's the pounce list. Again, it's just a short list of candidates that you'd like to own in the portfolio and don't currently own. That means they've been vetted. That means that whatever process you use to decide whether you like a stock, that process has been used on that list so that they should be ready to be purchased when the price is right. And again, that list should be relatively short. I'm suggesting 4, 5, 6 stocks at the most. Okay. Bethany wants to know, is there a way to tie the My iClub portfolio to manifest so that they're always in sync? Bethany, keep dreaming. Okay. We
Not
love dreamers. We love people that are dreamers, but we're nowhere near being able to do anything like that. an outside portfolio at the moment, at least.
Well, Kurt has actually looked at it, and we may be doing some of that in the not too distant future, but that's not first on our priority list. It's just
Absolutely.
it simply doesn't take very long to enter 12 tickers and 12 share totals. It
Yeah,
just
Bethany is also saying she doesn't see the prove or the core columns on her dashboard.
ah
When you're looking at your dashboard, Bethany, in the upper right above the dashboard, you'll see some buttons up there. One of those buttons, and here Mark is showing it to us now. One of those buttons, you're in. Are you in worksheets now? No. One of those buttons is actions right there. And Mark, if you click on actions, you'll see that directly beneath that now, the first thing on the pull down is columns. Even higher. There it is.
he,
And if you click columns, now you're allowed to turn off and turn on various columns. Right now, Mark did not have core. He's turning on RSI, prove, and core. I did not have RSI on my list. Caution, if you turn on too many columns, then you have to scroll the dashboard not only up and down, but left and right, and that is unwieldy. So I found that you can turn on 3 extra columns and not get out of sync with the width of the dashboard. If you turn on all of them, then it's really unwieldy. So that's how you get par and prove, not par, how you get prove and core onto your dashboard. We're at the end of questions. If I've missed your question, I apologize, but let me make sure. Yes, the amount of cash can always, Sharon is asking, can the amount of cash be shown on your dashboard? It's always available to be shown. And in fact, it stays at the bottom of the dashboard, right there in the last entry stays cash. If you look at it on this dashboard on Tin Cup right now tonight has 194,000 in cash. Mark adds stocks. Mark adds holdings to the portfolio every month, and we're at the end of the month, so there's a lot of cash in there at the moment. Okay.
yeah, Mark's been lazy.
Lazy also. Wait, I didn't say that. Did you say that?
I said that.
Okay. Tom, I think I've answered your question, and I showed you where you could add the core score immediately to your dashboards. You won't have to do anything except go into the actions, press columns, and then make core appear. That'll be easy to do. Mark, a question for you. Where does the financial strength and EPS stability numbers, where do they come from?
I'm sorry, you dropped out on me, Ken. Go ahead.
Where do the EPS stability and financial strength numbers come from?
We calculate them based on the profitability trend for the company when it comes to EPS stability. The difference is we include forward-looking estimates for the next couple of years, whereas Value Line, as an example, for EPS predictability, only looks at past history. So we think we get a little bit of an early warning edge. And what was the other? Financial strength?
Financial strength also, yeah.
Financial strength is basically an aggregation of Value Line financial strength, a couple other things. We take a look at the amount of debt and the effective interest rate that companies pay. That's basically the same way a bank would look at them and judge their financial strength. But again, we aggregate a number of sources, including Value Line, to make that calculation.
Okay, William Thompson is throwing me a softball. He wants to know, is there a place to find the definition of a term should you have a question? And Kurt has made that really easy. If you go to, Mark, go to, I don't know, go to one of the research pages for a company, okay?
All right. Research, companies. Let's look at Oracle. I hear Oracle's interesting.
Okay, there we go, Oracle.
It's right at the top. Imagine that.
And then, Mark, show them how Kurt has added definitions to a lot of things that you might not understand. There we go. Mark is now pointing to prove. Okay,
Oh, we
and
need
when
to
he
edit.
pointed with his cursor to prove, up comes a very, very short definition. But notice in the bottom left corner of the window that just opened, it says view in glossary. And if you click that, then you get a better definition of what prove is. And you'll also get some other places where you can look. If you look at the prove in the glossary, it directed you to an article completely about prove where you could actually see the arithmetic that goes into prove. So if you cursor over anything that you're not quite certain about, you'll be led on a nice path with lots of breadcrumbs that will take you as far as you need to go before you understand what the concept is. Bethany wants to know, what does prove stand for? Potential return on value, parenthesis, enterprise, or
It's
enterprise
it's
value.
enterprise value, and actually, that's not a correct definition. We will fix it. It's actually it's just a minor difference, but it's literally projected cash flow divided by enterprise value. It's a
Oh,
tiny,
you
tiny.
mean what AI put in the definition is not quite right, you mean?
Yeah, we have to go and catch AI in a few
Okay.
places.
Well, and that's going to be an ongoing issue, but that's relatively minor.
We have
So,
to de-brainwash it for about a couple of things. It tends to think that beta is important, and we don't even know how to spell beta. So
okay,
sometimes
I think we've covered all the questions right now. Again, on Saturday at 10 o'clock, we'll be looking at portfolios. I will try to enter the webinar about 45 minutes early, and I will be answering questions between then and the start of the program. So if you have a burning question that you have to ask, come on early, and I and Mark will try to get some of them answered for you again. It's 8:30 Eastern time. That's the end of this session, and we thank you so much for being with us tonight.
thanks for
Good
spending
night,
the time with us,
everybody.
and thanks for your curiosity. Take care out there.